All right. Welcome to Motivated Investors. My name is Patrick Harris. I'm starting this channel to talk about all things real estate and then some. So, a little bit about me. I am a real estate investor and property manager. I also run a contracting operation, and I have a real estate investment loan brokerage and a license to practice real estate in the state of Virginia. So today, what I wanted to talk about is the Treasury yields on 10-year bonds. If you're not familiar, 10-year bonds dictate what the interest rates are going to be on mortgages. This includes qualified mortgages, of course, for your personal residence, but it's also going to include the DSCRs. Everything's kind of stacked on top of the 10-year Treasury. So what we're looking at today is about 3 weeks of steady rates. I think the Treasury is running right now at 4.35%. So qualified mortgages are in the 6.25% range. Typically, they add about 1.9%. This is the margins that the banks are making. Now, qualified mortgages are very different, of course, from a DSCR. They're going to require income, tax returns, and it's just a more cumbersome application process. But you get a lower interest rate. Now, in the DSCR world, typically they're adding another 1.25% on top of what the qualified mortgages are adding. They do this because there's a little bit more risk in a rental property. Someone doesn't live there. It's just, you have a tenant and a third party who's occupying the space. The banks look at that in the underwriting and they say, okay, well, we need to charge more interest. So currently, that puts our DSCR rates in the 7.5 to 8.3 range. Now, the cool thing is when, because we're brokering a lot of different loans, we work with a lot of different loan products. I actually am sitting on my desk right now with a 6.75% interest rate on a DSCR loan. That's debt service coverage ratio for those that don't know. Debt service coverage ratio is only on rental loans. It takes the amount you make, the income, and it takes the servicing of the note, which is how much it costs to pay off the principal, interest, sometimes taxes and insurance. And that's the service ratio, so the debt to income, ratio against how much it costs to pay off each month against what it's bringing in. Anyways, where we are right now is, definitely looking at most loans are going to be in the sevens, but I thought that was pretty cool to see a 6.75. Now, it comes with a lower LTV at about 70%. Loan to value is LTV, by the way. This is how much against the value of the appraisal at the end of the project that you're going to be able to refinance out, how much cash you're going to get. We do have other products actually that are 80% right now. It's hard to find 80%, but we have at least one option. But the interest rates are a little bit higher. You'd expect that, of course. It's kind of the trade-off. But I just wanted to drop on here, get a first little bit of good information out into the world. Anything you guys ever need related to real estate, I'm here. I'm trying to make myself available, and I want to provide value and content. So if there's anything you'd like me to talk about, I've done a lot of deals with a lot of different creative strategies. I've got a lot of financing tricks. I'm excited to actually talk about some of this stuff and have a place to put it out there. So looking forward to getting more content in here soon. And thanks for joining me in the new Motivated Investors.